Today on Real Estate Backstage, a federal judge has issued final approval in the settlement with 9 real estate brokerages involved in the Gibson case. The DOJ has missed the official deadline to file an objection in the NAR settlement for the Sitzer Burnett case, although a handful of other parties have filed objections. We'll get into that. Real estate agents are now bringing their own lawsuits against NAR over the mandatory membership requirements. CoStar Group is doubling down on its investment in Homes.com. A stronger than expected economy is propping up home prices and interest rates. Appraisal guidelines get loosened up. And finally, a broker in Idaho is offering free listings and free guns as a way to get new clients. If you're watching this on YouTube, go ahead and subscribe to the channel. That way you don't miss any future episodes. If you're listening to this on Apple Podcasts or Spotify, please go ahead and subscribe. If you're feeling extra generous, you can leave us a rating and review. That will help these shows' discoverability, which will help us reach more people. And if you want to get the show notes with links to all the articles that we're going to go over today, you can go to realestatebackstage.com/episode 3. All right, let's jump into today's conversation. I want to start with the Gibson case. So Michael Ketchmark, who is the lead attorney in the Sitzer Burnett case, that's the case where last October, the jury awarded the landmark $1.8 billion verdict against NAR and its co-defendants. Well, within minutes of that verdict coming out, Michael Ketchmark filed another lawsuit in the same court targeting 9 other real estate brokerages who had not been named as defendants in the Sitzer Burnett case. This included Compass, Redfin, and others. Now, according to Inman, quote, as with many similar cases, the plaintiffs alleged that the defendant firms violated the Sherman Antitrust Act by enforcing rules requiring listing brokers to offer compensation to buyer brokers in order to submit a listing to a multiple listing service. The practice, the plaintiffs argued, artificially inflated broker commissions. A judge overseeing the Gibson commission case on Thursday granted final approval for 9 settlements involving companies including Compass and Douglas Elliman. Judge Stephen Bowe granted the final approval. In addition to Compass and Douglas Elliman, the settlements involved the Real Brokerage, At Properties, Redfin, Realty One Group, Engel & Vogler's, HomeSmart, and United Real Estate. Collectively, the companies will pay $110 million. And it's worth noting that the plaintiffs' attorneys are seeking 1/3 of those damages, and they're claiming to have spent over 100,000 hours over the last 5 years on this case. All right, so shifting gears back over to the Sitzer Burnett case and the big NAR settlement that we've been talking about a lot lately. So Tuesday, October 29th was the deadline for parties to file official objections to that settlement. And remember, there's a hearing scheduled for November 26th. That is the final hearing where the judge will hopefully approve that settlement. According to RAS Media, quote, while about half a dozen parties came forward, including plaintiffs behind other commission-focused lawsuits, and a law professor who has written critical analyses of the industry, one voice was noticeably absent, the Department of Justice. But that shouldn't necessarily be viewed as an implicit endorsement or a sign that law enforcement won't have anything to say on the settlement. Brian Schneider, chief counsel at Bright MLS, previously told RAS Media that he doesn't believe the DOJ are bound by the deadline and that Judge Stephen R. Bowe, who's overseeing the settlement process, is almost certain to allow them extra time, unquote. So while we haven't officially heard from the DOJ, a handful of other formal objections have been filed, urging the judge not to approve the settlement agreement. The most comprehensive objection was filed by Tanya Monastir, a University of Buffalo law professor. Now, according to her 132-page objection, quote, if there is anything that anyone agrees upon, it is that this settlement has caused mass confusion for both buyers and sellers. It is an example of something concocted by lawyers without a full appreciation of how this would play out in the real world, unquote. I happen to agree with that particular sentiment from the law professor from University of Buffalo. According to Housing Wire, quote, Monastir took issue with the business practice changes, saying they don't do enough to protect consumers. She also objected to the fees that are expected to be paid out to the plaintiff's attorneys. In her objection, Monastir claims there's ample evidence of agents asking buyers to sign modified buyer representation agreements, which allow the buyer's broker to increase their agreed-upon compensation to whatever the seller is offering. Monastir claims that the ambiguity around this practice in NAR communications and the settlement itself have allowed for this practice to occur, unquote. So a buyer representation agreement, just like any other contract, is an agreement between two parties. You have a buyer, and you have a real estate brokerage that is representing that buyer. Just like any other contract, the terms can be modified at any time, but only with the mutual consent of both parties. It's not like the buyer's agent can just unilaterally change the terms of the agreement to get more compensation. It doesn't work that way. So let's say, for example, that buyer's agent is working with a buyer. They've been looking at properties for an extended period of time. They've had an agreement in place at X% or X dollar amount. And now the buyer is interested in a property, and the seller is offering, or the listing brokerage is offering, a higher amount of compensation than what is outlined in the buyer broker agreement. There is nothing wrong with the agent approaching the buyer, explaining that, and attempting to negotiate an increase in their fee. Again, the buyer's agent cannot unilaterally enforce that or change that. The buyer has to sign off. They have to provide their informed consent. Now, some buyers in some circumstances will be perfectly fine with that. Maybe their philosophy is, as long as I'm not paying it, as long as the seller's paying it, I'm totally fine with that. Maybe they'll recognize how much work the buyer's agent has put in over the days, weeks, months, or maybe even years that they've been working together to find a property. Now, in other circumstances, the buyer might look at that and see an opportunity to get some of their other closing costs covered. And they might say, no, I'm not willing to increase your compensation. Instead, I want to negotiate that as a concession for me to use for other costs. And that's totally fine. That's how it should be. It should be a conversation and negotiation between the buyer and the buyer's agent. To say that no buyer representation agreement can ever be modified once it's in place, to say that that's a violation of the settlement agreement, I don't agree with that. I don't even really agree that it's a violation of the spirit of the agreement. I think the spirit of the settlement agreement was more about transparency. If you think about it, before these rules went into place, before the NAR settlement, oftentimes buyers didn't know how much compensation their agent was earning until they saw the amount itemized on the settlement statement. It's particularly true if all of that compensation was being paid for by the seller. And some buyers didn't even pay attention to the seller's side of the settlement statement. Sometimes buyers will just look at their column. Really, all they care about are, what are my fees? What do I need to bring to the closing table? So there was a real lack of transparency sometimes around how much buyers' agents were being paid. With the settlement, with the new rules, that's out the window. I think actually one of the benefits of the settlement, one of the good things here, is that it's kind of forced transparency. It's forced agents to have that compensation conversation, definitely to have it earlier in the process, because they should have written agreements in place before they tour any homes. So the new rules have created more transparency, and in my opinion, they put the buyer more in the driver's seat because they never have to agree to a modification of the agreement. All right, shifting gears. So back in August, 2 brokers and 3 agents affiliated with the Sotheby's franchise in Michigan filed a lawsuit against NAR over the mandatory membership requirement in order for them to gain access to a particular NAR-affiliated MLS. According to the suit, quote, "The requirement of membership in the named realtor organizations constitutes a conspiracy to monopolize the use of the MLS and creates barriers to the market for all realtors, agents, and brokers who seek to enter the market but who not wish to belong to one of the named realtor organizations," unquote. According to RIS Media, quote, "Besides NAR and the Michigan Association of Realtors, the lawsuit names 2 local realtor boards, with the plaintiffs claiming they had to join all of these organizations in order to access the MLS. It also targets RealComp2, the software company that manages and regulates the MLS," unquote. NAR responded to this in a blog post on their website saying, quote, "Limiting MLS access to realtors is legitimate and lawful. In litigation, challenging the MLS membership access rule can be successfully defended," unquote. Now, a similar lawsuit has been filed in Pennsylvania by a broker named Maurice Muhammad. According to RIS Media, quote, "Muhammad, representing himself, is suing the National Association of Realtors, the Pennsylvania Association of Realtors, and the Greater Lehigh Valley MLS for $5.6 million over the requirement that he become a realtor in order to be able to access the MLS," unquote. So my thought here is that just because an MLS exists doesn't mean you are automatically entitled to its data. For example, I am a member of the Greater Greenville Association of Realtors here in Greenville, South Carolina. That's where I hold my primary membership. I joined about 8 years ago, and the primary reason I joined was to get access to the Greenville MLS, which is owned by the Greater Greenville Association of Realtors. Now, in order for me to join GGAR, I had to also simultaneously join the South Carolina Association of Realtors and the National Association of Realtors. But cumulatively, for all 3 of these organizations, the local, state, and national association, the cost is only $575 per year. It's not a huge barrier of entry. And the MLS charges $145 per quarter. So, in my opinion, it was worth it. And that's the point. I made the decision to join. I didn't have to join. Every brokerage in my area has to do their own cost-benefit analysis. They can choose to join these associations in order to get access to the MLS, or they could choose not to. And I think the majority of people choose to join because they see enough value in it that the benefits outweigh the costs. Now, would I like to see some consolidation in the industry? Yes, I would. For example, in my area, in the upstate of South Carolina, we've got a whole bunch of associations and MLSs. The big three are the Greater Greenville Association, the Spartanburg Association, and the Western Upstate Association. I really think those three could be merged. I think that would be of value to the members. I'm personally a member of 13 or 14 different MLSs across a few states just to get access to data. I would love to see some consolidation there so that I wouldn't have to be a member of so many different MLSs. I would like to see that happen. But at the end of the day, I could choose not to be a member of any of these particular associations or MLSs. But I've made the decision that it makes sense for our business because the benefits outweigh the costs. All right, in other news, CoStar Group, which is the parent company of CoStar, LoopNet, Apartments.com, Homes.com, and a handful of other websites, they recently announced revenue growth of 11% in the third quarter, and they reaffirmed their commitment to continue investing in Homes.com, which is the residential real estate search portal that they acquired back in 2021. So the Homes.com team, they had a big marketing push in 2024. If you're a real estate professional in the United States, I'm sure you were exposed to a variety of different types of marketing from Homes.com over the course of this year. You probably received a handful of direct mail marketing pieces from them. You've probably seen their ads on social media. I'm sure you've seen their ads on TV. If you watch the Super Bowl, they had a handful of Super Bowl commercials this year. They've hired celebrities to be in their ads. They have made a very big push, and they have committed to the same marketing budget for 2025. They're going to continue marketing, and they're going to continue hiring sales reps to bring on more real estate professionals as paying members of Homes.com Pro. So according to RAS Media, quote, CoStar Group founder and CEO Andy Florance told investors on an earnings call this week that the company is bullish on its Homes.com business despite a drop in bookings. Florance pointed to larger shifts in the real estate landscape as being favorable to the Homes.com model, continuing to criticize the lead diversion business favored by rivals Zillow and Realtor.com. He also pointed to both the NAR settlement and the pressure to change Clear Cooperation as a potential boon. During the call, Florance fielded questions from investors, allaying concerns by emphasizing the long-term viability of the Homes.com model. Florance also reiterated his belief that Homes.com, your listing, your lead model is what both consumers and agents actually want in the long run, unquote. So with other portals like Zillow and Realtor.com, their two biggest competitors, they make money primarily by selling leads. And when a consumer is on one of those websites, either Zillow or Realtor.com, they see a property they like, they click the button that either says, I want more information about this property, or I'd like to schedule a tour of this property. That does not necessarily go to the listing agent. A lot of consumers don't necessarily understand that when they're clicking the button. But Zillow, Realtor.com, they make their money by selling those leads to other agents, whoever happens to be purchasing leads in that particular zip code. With Homes.com, their business model is different. They deliver leads directly to the listing agent 100% of the time, and they make their money by selling other types of ads to real estate professionals, primarily through increased exposure on your agent profile or for your listings. So I've got mixed feelings about this. I don't think one way is necessarily moral or immoral, right or wrong. I think different business models. I think a lot of consumers do have this initial thought that when they click the button, they're reaching out to the listing agent. So it can cause some confusion when someone else reaches out. However, sometimes you're going to get a better experience as a consumer. I don't think it is necessarily in the consumer's best interest to always deal directly with the listing agent. Now, they have every right to do so if they want to. But also, I think if an agent is buying that lead, they're more incentivized to respond faster. If you're a listing agent and you get a whole bunch of inquiries on one of your listings, you may not prioritize, you should, but you may not prioritize getting back to those leads as quickly as you should. I think, that has been the case in the past where people try to reach out to the listing agent, maybe through an online portal, or they call the number on the sign and they don't get a response. They don't get a response as quickly as they would like. So that is one benefit to the consumer of those leads being sold to a third-party agent is that agent supposedly would be hungry and motivated. I mean, after all, they're paying for the lead. They don't want to waste it. So they're going to be more incentivized to call quicker, provide a great experience and try to earn that business. I can certainly understand the appeal as a listing agent if you have a lot of listings that you would prefer to have all those leads come to you. rather than have them sold to a third-party agent. Personally, I really built my business on Realtor.com and Zillow leads. When I was a brand new agent, I just got into the business. I didn't have any listings yet. And so that was a great way for me to get leads of people who were interested in learning more about particular properties. So the unexpected resilience of the U.S. economy may be propping up home prices and also interest rates. According to Inman, quote, the surprising strength of the U.S. economy has quelled fears of a recession, but that also means home prices are likely to keep rising and mortgage rates may not come down as quickly as previously expected, Fannie Mae economists said Thursday. Rather than a recession, Fannie Mae's Economic and Strategic Research Group sees economic growth as measured by gross domestic product slowing from 3.2% in 2023 to 2.3% this year and 2.0% next year, unquote. And according to RIS Media, quote, the U.S. stands out as a growth outlier compared to other major economies, with the Federal Reserve likely to keep interest rates higher for longer than its global peers, unquote. So yeah, I mean, the U.S. economy has been humming along. So far, it's been able to avoid the recession that everyone has been afraid of ever since the Fed started tightening up its monetary policy in an effort to battle the 40-year high inflation. There have been some renewed attention, renewed concern about the ballooning deficit and national debt. As interest rates have gone up, that's really come more to the forefront because that means the interest payments, the servicing of our debt has become more expensive. But as long as the economy keeps humming along and unemployment doesn't get too high, the Fed is probably going to feel comfortable with bringing their rates down slower as opposed to loosening policy too quickly. All right, next thing I want to cover is the FHFA has loosened their appraisal requirements. So according to Housing Wire, quote, the Federal Housing Finance Agency has expanded the eligibility for alternative appraisal methods on purchase loans by increasing the maximum loan-to-value requirement. The announcement was made on Monday during the Mortgage Bankers Association annual convention and expo in Denver, Colorado. The maximum LTV ratio will increase from 80% to 90% for appraisal waivers and from 80% to 97% for inspection-based appraisal waivers, unquote. Okay, so there have been a lot of advances in AI, and some of these automated valuation models are maybe getting a little bit more reliable, more accurate, but there is still a very legitimate risk in removing human appraisers from the equation. And some of these loan to values are pretty darn high. So I'm a little nervous about this, to be honest. To go from 80% up to 90% on appraisal waivers and all the way up to 97% for inspection-based appraisal waivers, it seems a little risky. And this is not just a gut instinct, a gut decision made by the loan officer or the processor or the underwriter. In order to get an appraisal waiver, you do have to get confirmation of that through the automated underwriting system. So for example, desktop underwriter, loan prospector, when a mortgage company submits a file for automated underwriting, it's run through the algorithm and it spits out a decision as to yes or no, whether or not an appraisal waiver is going to be granted on that particular file. And it's based on a variety of things, such as the loan to value, how much the borrower is putting down, the overall strength of the borrower's file. So if they have a good credit score, good debt to income ratio, things like that. The stronger the borrower's credit and income and assets, the more likely you're going to get an appraisal waiver. It's also based on how confident the algorithm is in its valuation of the property. So with a standard appraisal waiver, it is just relying on desktop underwriter, loan prospector, and this collateral automated underwriting system to make the decision as to whether or not they're going to require a human appraisal. With an inspection-based appraisal waiver, you're not hiring an actual licensed appraiser, but you're still sending someone out to the property to collect data, take some pictures, maybe do some measurements. This would be done maybe if the automated system is not quite as confident in its valuation model. So this might be more common for properties where maybe there aren't as many comps in the system. Maybe a property, maybe in a more rural area, more unique property, more acreage, fewer transactions going on in that particular market, things like that. So an Idaho broker named Mark Fitzgerald has come under fire, no pun intended, pun intended, for offering to sell liberal homeowners' homes for free if they're relocating out of state. And he's offering to provide conservative buyers moving into the state with a free AR-15 at closing. Now, regardless of your political ideology, you've got to give this guy credit for the creative marketing. This is a publicity stunt. Apparently, no one has actually taken him up on the offer yet. But he's gotten all kinds of attention, especially in his local market from news organizations, for this offer that he put on social media. Now, some people are accusing this as being a violation of fair housing in some way. I don't see that. Political affiliation is definitely not one of the protected classes, at least not at the federal level. Maybe it is in Idaho. I don't know. But being a Republican, being a Democrat, your political views are not a protected class. So theoretically, you could choose to discriminate against someone based on their political leanings. And while that may or may not be a good business practice, I don't see that as being a fair housing violation. All right, y'all, that'll do it for the show today. I'll see you next time for a behind the scenes look at the real estate industry here on Real Estate Backstage.